Mapletree Logistics Trust has just announced their recent Q1 FY2425 results, with DPU dropping 6.5% Q over Q and 8.9% year over year to 2.068 cents. As a dividend stock, it is never good to have a drop in DPU, because this means that at the current share price, the dividend yield of the stock drops due to lower dividends given and expected. There are a few reasons which led to the lower dividend, and we will go through it in this video. Just a quick introduction for those who are new to MLT. They are a Reit which owns purely logistic properties, and logistic is an in-demand property class. However, because of one of the major assets in certain country that is not performing well, is leading to lower performance for MLT. So let us get right into their results. If you have seen my previous video on MLT's earning preview, I mentioned about the potential risk in the drop in DPU for MLT. The results seems bad across the board in this slide. Revenue, NPI and DPU came in lower year over year, with DPU coming in the lowest at 8.9%. We will take a look into the reason why later. Occupancy, rental reversion and leverage ratio is also not doing well for this quarter. Looking at their quarter-over-quarter results, revenue and NPI was up slightly instead of negative value year over year. Good thing is that property expenses came in lower due to MLT's management portfolio optimization. However, borrowing costs still went up by 3.3%. Interestingly, MLT's dividend drop this quarter was the same concern I had previously with Mapletree Industrial Trust. While Mapletree Industrial Trust had new properties to compensate for the dividend income once the divestment gain was given, MLT did not have. That is why if you see the note 3 and 4, for last quarter, there was 12 million of divestment gain included in the dividend income, which accounts for 10% of the overall income. Similarly, for this quarter, 5.7 million accounts for about 5% of the distributable income. So as an investor, I will always calculate the expected dividend if there was no more distribution from these divestment gains. This led to DPU coming lower at 6.5% Q over Q. Another factor that is lowering their dividend is the Distribution Reinvestment Plan program. It allows shareholders to receive their dividends in MLT units instead of cash. This led to 0.4% Q over Q increase in the number of units, while 1.5% year over year. This dilutes shareholders and thus causing share prices to drop if their revenue or dividend do not increase. The third factor that affected their revenue is foreign currency weakening of Japan yen and Korean won, with both bringing in revenue of 11.4% and 8.2% respectively in their overall assets. The continued weakening of the currencies would equate to lower amount of Singapore dollars. The rising borrowing cost is another issue for MLT, and it will be common for all REITs. Lastly, the biggest issue that MLT is facing is the property rental renewals for their China properties. China properties accounts for 18.3% of MLT's overall revenue. The main problem is that 51% of the lease expiring this quarter was China tenant, which recorded a very low value of negative 11.3%. Honestly, this is worse than I thought, which again shows how hard is it for China economy to recover. If we look at their lease expiry this year, they still have 10.5% of the China tenant leases that will be expiring. With the possibility of negative rental renewals, this will definitely drag down MLT's property income and result in lower dividends. Another main issue that is dragging down MLT's dividend is similar to other REITs, and that is the increasing cost of debts. Their cost of debts is surprisingly low at 2.7% with adjusted interest coverage ratio of 3.1 times. But having a low cost of debt would mean that once any refinancing of their debts occur, and if the new debts refinance is more expensive than their current cost of debt of 2.7%, MLT's overall debt expense will definitely increase. That is the problem, as most of the properties are located in countries that has much higher than 2.7% in interest rate. So therefore, the probability of the cost of debt going up is very possible. Leverage ratio came in higher due to acquisition of Malaysia and Vietnam assets, which is expected. Overall, what are the main problems that MLT is facing that resulted in lower DPUs? 1. When revenue growth is lower than the growth in expenses or finance costs, it leads to lower income. The only way for Reits to increase much more is through the new growth in their new properties. For MLT, the closest property will be in first half of 2025, where this enhanced property will finally be a boost for their income. Next, because of the constant distribution reinvestment plan that MLT is running, it has been slowly diluting shareholders. So as a shareholder, if you believe in MLT, then it is important to be involved in this DRP program to earn the MLT units. Third, with MLT having so many overseas properties, the strengthening of the Singapore dollar will definitely have an impact on MLT's income from overseas. And lastly, is the bad rental renewals in their China properties. Hopefully in the near future, China economy will recover and logistics will become in demand again. When the time comes, it will definitely benefit MLT. This resulted in their dividends declared to be 2.068 cents. At the current share price, the dividend yield will be dropped to 6.3%, assuming same dividend for the next few quarters. But if the share price drops, the dividend yield will definitely go up. In my opinion, as long as they have the China leases being renewed at negative rates, this might be one of the main factors that will hinder MLT's revenue and income growth. However, MLT is still a solid unit with credible management. So, with the drops in share price, they might look attractive if it reaches a safe dividend yield for you to purchase in. Thank you so much for watching. I hope you enjoyed this video. Please support the channel by hitting the like, subscribe, and comment on what you feel about MLT's recent results as well. You can also watch my previous videos on the earning previews for banks and the interest rate impacts on REITs. Thank you, and I'll see you in the next video.